Just great. And so whenever you are ready, launch away.
Yes. Okay, so I'm going to start with a little story for you guys. A lady goes to see her doctor, and she's very, very sad and troubled. She has some weird symptoms, and she doesn't know what's going on. So after examining her, the doctor says, guess what? You have 6 months to live. She goes, oh, doctor, what am I supposed to do? How can I get around this? He goes, I've got the best thing for you. Marry a CPA. She's like, why would I do that? Because at least those 6 months will seem longer. I thought it was amazingly cute. So today I'm here to tell you about what most people consider the 8/9 main steps of the accounting.
Do you want help on that?
Yes, please.
Okay, Matt, you want to help? Okay.
Appreciate it. So, according to most accountants, there are eight ways to do the accounting cycle. There's the transaction, which is basically saying, okay, I purchased this, usually it involves money. Inventory for money, or land for money, or there's one that doesn't involve money at all. It's called a note payable. It's basically saying, I'll pay you later, like a credit card. Basically, it's the financial process that includes the sales, returns of products, or the purchase of supplies. A transaction takes place every single time. Slide. When you're doing your transactions, the first thing you have to do is set up what we call the chart of accounts. These are some examples. Most asset accounts start in the 100s, simply because they're the easiest to remember. Companies always start in the 100s to 200 range, even if you're sole proprietorship. Typically, the bank is what we call cash on hand, is usually 100. All of these will not be used. Liabilities are 200, and capital accounts or owner's equity, stockholders, are always 300 level count. Now, if you have a company that sells goods or makes and processes goods, then you'll have the bottom line. It's called cost of goods sold, or COGS as we like to call it. It's basically what happens when you take your beginning inventory, plus your purchases, and subtract out what's left. Okay, these are samples of journal entries. Basically, a journal entry is something that you do after the transaction is made. It's like taking your checkbook and putting, okay, honey, I spent so-and-so on this. Your wives love that, guys. They do. Or girlfriends. But here are some examples. We have prepaid insurance and insurance expense. One is an asset and one is a liability. All expenses are liabilities. All assets are prepaid. Sometimes it doesn't work that way, but mostly it does. This is what we consider the trial balance. After all your journal entries are completed, you go into the trial balance, which is usually at the end of a reporting period. The trial balance is done to make sure everything balances out, hence trial balance. If your balances of your debits and your credits don't equal, you made a mistake. That's the easiest, simplest way I can do it. On the very bottom, if you note, it's hard to see, it says trial balances serve to detect any mathematical errors that occur in the double entry system. Double entry system is what accountants typically use, usually because you're affecting more than one account. You don't take money out and do nothing with it. You take money out and you purchase something, hence double entry. The worksheets are involved. There's the trial balance, there's the income summary, there's the statement of cash flows, and then, of course, there's the balance sheet, which we are going into. Okay, with the adjusting entries, once you make all your balances from your trial balance, you go in and you tell them, this is what I need to do. I bought prepaid insurance, and I've only used a portion. Usually prepaid insurance, i.e. car insurance, is paid at a 6 to 12 month interval, just like health insurance, with certain companies. Some pay it month by month. But with the accounting way of things, we do what we call accrual-based accounting. It's what we do every month to make sure everything works out. Basically, it says if you're using the accounts receivable, you've made either a purchase or a sale. Simple as that. You've made money, so you have to offset it so it's correct. Otherwise, your bank statements and your accounts are wrong, and we frown on that. Now, this is very simple. This is your financial statement. This is actually two side-by-side for comparison. Your income statement, which is usually done by the end of each month, and your balance sheet, which is done by a specific period in time, which is usually the same day that you do that. The income statements are, like I said, monthly, where the other one can be every 2 weeks if you need it. Make sure you're balancing out properly. Basically, it summarizes what the company's accounts, assets, liabilities, and owner's equity equals. Now, as an accountant, we have what we call ALO. It's called assets equal liability minus owner's equity. ALO. I know it sounds weird. Just remember that stuff you put on your pan when you burn yourself. It works for it. If you remember that, you can never go wrong. Basically, this tells you that the balance sheet has to equal out. Anything that you use for the assets, i.e. the cash and the accounts receivable, and the equipment must equal what you spent in total liabilities plus your owner's equity. Otherwise, you have made a mistake. Now, when we're defining this, the income statement shows you what you own and what you owe. Shows the wealth and health of your company. And it looks really nice for stockholders, investors, etc. That is what we call an outsource. For financial statements, we use this very often. We use it for inside, but external people want it as well. Now, my favorite part. This is called closing the books. When you're closing the books, you have the most amazing thing happen. You're taking accounts such as expenses, and because you will not need them, you keep the account open. However, you're just going to close them for the year ending. So what we do is we make an imaginary monetary fund called the account income summary, which is basically an account that holds the funds. And then we close out all the expenses into that fund, and we go from there. And then we'll be done for the rest of the year. And we should be fine. Then we can start out the new year happy-go-lucky.